That's good.
Yeah.
Excellent. Welcome everyone. It's the life cycle of a private capital fund, a joint event between A&M Tax and Langham Hall. My name's Reese. I'm a partner at A&M, and I lead our funds tax team. So at A&M Tax, we cover a large amount of tax structuring for private capital funds, so fund structuring, tax reporting, carrying co-invest and personal tax work. But this event isn't just about tax. It's also covering some of the broader administrative and regulatory issues for private capital funds. So we work closely with our friends at Langham Hall to produce this event. I will let everyone introduce themselves in turn. So on that note, over to you, Shirley.
Hi everyone. I'm a tax director in the Alvarez and Marcel funds team. I have about 10 years of experience helping asset managers and fund advisory work mainly. Lewis?
Hi everyone, I'm Lewis Whitehall. Got 7 years of experience, currently tax manager within Alvarez and Marcel, previously with focus on more open-ended side. Pass it over to you, Nancy, from Langham Hall.
Thanks, Lewis. Hi everyone, I'm Nancy. I'm a commercial manager in the London office at Langham Hall. I've been with the company for about 8.5 years. I'm a chartered accountant, and my current role involves helping new and existing clients with structuring, regulatory and ongoing operational considerations. Prior to this, I managed a team providing fund admin services to pan-European real estate managers. And this is my colleague, Helen.
Hi everybody, I'm Helen. I head up the operational team on the appointed representative side of things here at Langham Hall. I've been at the firm for just short of 4 years, and I have experience of a wide range of compliance issues, including reg cap assessments, financial promotions, and regulated activity. That means I tend to enjoy speaking about regulation for hours on end, but I do promise not to do that today. We can leave that for questions.
Thanks, Liv. And as a very high-level introduction to Langham Hall, so we're an independently owned, partner-led fund administration AIFMD service provider. So that's everything from the day-to-day bookkeeping, quarterly reporting, and we also have a full-scope AIFM and depository, London and Luxembourg, and carry out a number of other regulatory services. Apart from our head office in London, we have offices in New York, Jersey, Guernsey, Luxembourg, Hong Kong, and Singapore. We have 800 people globally, and we work with liquid fund managers across all asset classes. That's from first-time fund managers setting up their first-time fund, or multi-billion global fund managers.
So in this session, we'll be covering the following: key market updates in relation to private capital funds, a general life cycle, tax considerations, management and administration considerations, as well as hot topics. Reese, I'll hand over to you for the key market updates.
Sure. So I think in terms of the key market updates in relation to private capital, the sort of biggest trend at the moment has been the issue raising fresh capital, and this is something a number of private equity and infrastructure funds have sort of flagged to us. There are still opportunities for growth though, and what we see is that private capital funds with a niche or very specific area where they're looking to invest have still able to penetrate the fundraising market. I think in terms of fundraising, we are starting to see that pick up a bit coming into first quarter of 2024. So lots of our clients are talking to us about prospective fundraisers aiming for the middle of 2024. So we're kind of working on them with their structuring and working with their lawyers to get the products ready to go from the start of the year onwards. I think this third point here is around private credit, and this is a much more recent phenomenon whereby the private credit market has has weathered the sort of economic storm a lot better than the private equity and infrastructure markets, insofar as what we're seeing quite a lot of is typically private equity businesses setting up their own private credit arms to either refinance their own assets or to act as a lender to third-party portfolio companies. Obviously, there are tricky issues with that in an inflationary environment, in changing the skill set of your team if you've got an equity background to moving to a credit business. But that's one area that we are still seeing strong growth. And last but not least, an ESG focus. This has been something that this is a much longer term trend where asset managers have been looking very closely at ESG as part of the investments that they make, both in terms of typical private equity buyout funds looking at the type of investments they make, and also specialist funds targeting ESG and using that as a way to specifically raise capital. I think this is quite true in the private equity sector, and in the infrastructure sector, we're also seeing a lot of focus on renewables and renewable energy and how that feeds into the infrastructure network. And again, that is an area where there's still a large amount of growth. So I think that the overall summary would be it's been a tough year for fundraising. It continues to be a tough market. There's light at the end of the tunnel, and we're sort of seeing these green shoots of recovery in 2024. But there's still fairly strong, resilient growth in private credit and where there's an ESG focus.
Cheers, thanks for that, Rhys. I will just give a brief overview of the Lifecycle of Private Capital Fund before we dive into the tax administration considerations, which is the focus of the webinar. Depending on the type of fund, cycle could be as short as 3 to 5 years for potentially credit funds, or up to 10 to 12 years for venture capital or private equity, possibly even longer for infrastructure. We just want to make it clear that there is no standard life cycle. It won't start until the fund manager raises substantial capital, and it won't end until all the assets are eventually sold, so it could stretch much longer. Furthermore, stages do tend to overlap. Investments could happen at, say, the fundraising or the fund establishment stages if the right opportunity does arise. For us as advisors, understanding these changes and how they may apply to the fund manager's business itself is critical to being able to provide the robust advice and support that they need. So stage 1, business planning, that's where the cycle begins. The fund manager would typically consider the fund's investment strategy, whether there's a unique selling point. Is there a sector or geographic focus based on the fund manager's experience or interest? What is the ultimate purpose of the investment? Is it to achieve long-term capital appreciation, strong income generation, possibly even to achieve even higher returns by undertaking riskier investments? Are there any specific investors that would be targeted, or how is the structure designed? Does it include carry or co-investment entities? How do the fees flow between these? Do they have the right team, or is it still being built? Are there new hires that are still being sought after? All of these aspects feed into how the investment plan or strategy can be marketed to these investors. And at these various points, they will require input from legal, tax, and administration teams. At the fundraising stage, fund managers typically go on to implement marketing strategies to secure these investors. We want to really emphasise the importance of having the design of structure that works from both legal, tax, and administration perspectives. And we'll go on to talk about some of these considerations later. The structure design is typically shared with the investors, so the investors may want to renegotiate specific terms that are required in order to secure their commitment, and that could add even further complexity into how everything works in practice. The fund establishment stage is where the legal entities are formally set up to enable the investments, following the design under the business planning stage. Next, at the investment, the fund will broadly structure and make new investments, due diligence, valuations, term sheets, negotiations. All of this would be carried out, again, typically with input from professional advisors. Some distributions may be made from income-producing investments, or investor commitments will be called upon to raise more capital and pursue more deals. Key stage is the value extraction, where the focus is on growing the value of the investments made, which could be done by example, providing further strategic and operational support, potentially making follow-on investments, or reducing fees. The focus is on creating value rapidly, which ultimately will lead into the investment exit stage, where various options could be explored. M&A exit strategies, IPOs, management employee buyouts, or secondary sales. On exit, there might be returns to investors, but consideration must be made to carried interest or co-investment holders, which need factored in. And then finally, the winding up stage broadly involves closing down the operations of the fund business, sale of the assets, and settling all the liabilities. To the extent that there are any unrealised investments, the fund term may be extended. And across all of these stages, we'll now go on to explain both the tax and administration considerations and why it's important to be continually aware of this. Shirley.
Thank you very much, Lewis. That's really helpful. So tax should be considered at every stage of a private capital fund's life cycle. In the following slides, I will go through some of the key tax considerations which apply to each stage. Note that these aren't exhaustive. So the design of the fund structure should ideally be considered as part of the business planning stage and be used in the fundraising stage as part of marketing efforts. We have extensive experience on helping asset managers design their fund structures, and we'll consider a number of things when determining how the fund should be structured for tax purposes. So investor base. Generally, if investors are based in the EU, then they may prefer to invest in a structure in Luxembourg. If not, then the fund could be structured in the UK or offshore in the Cayman Islands or Channel Islands. Delaware is also another option. Certain investors may not want to invest in an offshore structure as their jurisdictions may impose additional tax and reporting obligations. Regardless of which jurisdiction investors prefer, investors are keen to minimise local tax liabilities that may arise in the countries where the fund is located and from which it is managed, as well as where the fund makes its investments. So it's important to ensure that there's no direct tax leakage at the fund level or any withholding tax on distribution from the fund to the investors. The second one, investor type. So institutional and private investors have different reporting obligations. Private investors may prefer to use another feeder entity, for example, a company as a blocker for tax and reporting purposes. Jurisdiction and nature of investments. Direct tax and withholding tax leakages can potentially arise on interest and distributions from the jurisdiction where underlying investments are located, with onerous tax filing and reporting obligations for investors. To mitigate this, the fund may hold a holding company which owns all of the underlying investments. It is important to ensure this holding company has sufficient substance and a commercial purpose for being established in this jurisdiction to benefit from exemptions or reductions in withholding tax under domestic exemptions or double tax treaties. And I will go on to talk about the qualifying asset holding companies regime, which the UK has recently introduced. The next point, taxation of investment returns, carried interest and co-investment. It is preferable that investment returns are taxed as efficiently as possible. Generally, capital gains are subject to tax at lower rates compared to income, for example, interest and dividends. There are anti-avoidance rules which could deem amounts to be subject to income, such as the disguised investment management fees rules, if certain exemptions are not met. So for example, to carry and co-investment exemptions. So it is important to structure arrangements to fall within these exemptions where possible. Size of fund. For investment funds with a size of below £500 million, we would generally expect it to be cheaper to operate the fund based in the UK. compared to in the Channel Islands or the Cayman Islands, though the tax savings would need to be looked at. Funding of general partner commitment by fund executives. So fund executives may be required to do this, and they have a number of options. So personal funding, personal borrowing from a bank or mezzanine finance house, an external fund finance facility, or management fee waiver, where some fund managers could choose to satisfy part of their GP commitment via a cashless contribution of their management fees from the fund. So here is an example of a private capital fund structure with a UK fund manager. Here you have the common fund vehicle, which is generally structured as a limited partnership. And this is because we want it to be tax transparent, and so no tax leakage could arise at the fund level. The same as the carry and co-investment feeder, we would generally structure this as a tax transparent limited partnership vehicle. The general partner would generally be structured in the same jurisdiction as the fund vehicle. Further consideration should be had in relation to the general partner's remuneration arrangements. For example, we should consider whether it's better for the general partner to receive a management fee or a priority profit share to mitigate tax leakages, which include VAT. It is also important for the general partner to demonstrate that its central management and control takes place in its jurisdiction rather than, say, the UK, to prevent the general partner being deemed to be UK tax resident and falling within the UK tax net. So a UK manager or investment advisor could be a UK limited company or a UK limited liability partnership. The choice largely depends on cash retention. So profits retained in a private limited company in the UK should be subject to corporation tax at 25%, whereas as a limited liability partnership is tax transparent, members' profits will be subject to tax as trading income, currently up to 47%. As discussed in the previous slide, the fund, in order to mitigate tax and investors to mitigate tax, could have a master holding company, which could be a qualifying asset holding company or another overseas entity. And I'll discuss that a bit later. Depending on the jurisdiction of the fund, a specific regulated entity may be required, for example, an alternative asset management, alternative investment fund manager, and Langham Hall will talk more about that. So moving on to the stage of fund establishment. This stage is where the various entities are set up following the design and will typically provide detailed tax and reporting advice in respect of each of the fund vehicles and in respect of investors and fund executives. For entities, advice can include not only direct tax implications, but also indirect tax implications such as VAT, transfer pricing, VAT, where fund entities may require to provide information about their foreign account holders to tax authorities to combat tax evasion. For fund executives, employment tax considerations can apply and will typically suggest like things like tax elections to mitigate tax exposures. In respect of the investment stages of the life cycle, we will provide due diligence work, investment structuring work, and tax modelling. Value creation is where the investments of the fund will be maximised. Here we will consider typically tax reporting, so different income streams would need to be analysed accurately to minimise the tax that needs to be paid whilst reducing risk. I've already mentioned FATCA. Investor reporting, so investors will need information to file their own taxes, and there may be inheritance tax and family and trust issues that may need to be considered. On exit of an investment, we could help provide sell-side due diligence to ensure transactions progress smoothly and that the fund receives maximum value, and also tax reporting. And finally, on the winding up or extension of the fund's term, we could help with the final filings on the winding up and also advise on the tax implications of extending the fund, including whether any restructuring is required. In terms of specific tax considerations for different funds, so generally what I've just mentioned applies to all of the funds, so like venture capital, private equity and infrastructure funds. For credit and real estate funds in particular, there are specific points to note. So for credit funds, many credit funds with a UK manager rely on the investment manager exemption to ensure that the UK manager's activities don't cause fund investors to become subject to UK tax solely as a result of their investment in the fund. Care with the UK investment management exemption, particularly where the fund manager expands its direct lending activities, should be taken. The UK also has these income-based carried interest rules, which are very complex and can kick in where a fund's weighted average holding period of its investments is less than 40 months, or if the fund is a direct lending fund. So, and if these rules are met, amounts could be taxed as trading income. So it's really important to ensure that these rules could potentially be gotten around. For real estate funds, there are various structures, for example, the Real Estate Investment Trust, Jersey Property Unit Trust, co-ownership authorised contractual schemes. So it's important to be aware that there are a number of other structures that could be considered aside from the limited partnership structure, depending on what you want to commercially achieve. For real estate funds, it's also important to mitigate stamp duty, land tax and VAT costs on acquisition in an investment structure. It's important to maximise opportunities to claim capital allowances. It's important to minimise or shelter non-resident capital gains tax, which could apply to non-residents who hold UK property or UK property investments. It's important to minimise tax costs of property ownership and operation. So these are specific considerations.
Thank you, Shelley. Thanks. So now I'll run through some specific administrative considerations for the different categories of investment funds. I won't cover anything to do with structuring or regulatory aspects. That will come at a later point in the slides. So to start with, there are a number of overlapping considerations across all asset classes, which I'll run through first. Firstly, asset and investment valuations. For most alternative investment funds, there are no statutory requirements for this, so for these valuations to be outsourced. However, there are some LPAs that will state that this does need to be outsourced. We see it quite often with real estate funds where at least once a year they need to outsource the asset valuations. It's really important to make sure that you're aware of what the situation is in your LPA with that. When the valuations are carried out in-house, the finance and investment teams tend to work together to prepare these calculations. Bear in mind, it can be quite complex and time consuming, so it's something that really needs to be factored into the timings for the quarterly and annual reporting. Next point, investor reporting. Once again, across all asset classes, investors are becoming increasingly sophisticated when it comes to their reporting requirements. And there are a number of industry bodies, for example, the INREV for real estate and the BVCA for venture capital and private equity, who are continually issuing reporting guidelines with the ultimate goal of increasing transparency. My recommendation would be for managers to join one of these boards relating to their category of fund. So the preparation of investor NAV statements in particular tend to be outsourced to a fund administrator like Langham Hall, and it's very important that the way in which these these NAV statements are reported are in line with what the investor needs. In addition to the prep of the reporting and the information provided, there's the question of how these reports are distributed to the investors. So go back 5-10 years ago, a lot of managers were actually sending out drawdown and distribution notices and NAV statements via email to their investors. Obviously, the drawbacks of this is that it's very time consuming for either the fund manager or the administrator to do. It's also at big risk of human error, and there are definitely security risks there. So what we're seeing now is a lot more sophisticated investor reporting, investor portals coming out into the market. And I would say that with most of our clients now, all statements are issued through these investor portals. Fund finance is also an important consideration. So in a typical investment fund, cash is usually only drawn from investors as and when it's required. This means that there's a higher IRR for investors and less of a cash drag on the fund. But from an ongoing operational perspective, this can sometimes cause problems. So the timing of drawing investor cash versus the short notice sometimes required for deals can cause a bit of a bridging gap with funds. So because of that, a lot of the time managers use credit lines and NAV facilities from third-party lenders, which help stop with any of the delays with any deals from going through. Final point across all categories is waterfall mechanics. So the way that a waterfall is calculated is always specified in an LPA, and it tends to follow the model of management fee plus carried interest, along with what we call any hurdles based on performance of the fund. One thing that managers probably don't pay as much attention to when they're setting up the fund is any clawback mechanisms. So that's basically if the fund hasn't performed as well, the manager actually has to pay back some of the management fee. It's really vital that you and your team and your administrators know the LPA inside out, especially the waterfall mechanics from the start, as this can get quite complex and difficult towards the end of the fund life. Some specific points relating to different categories of funds. So with credit funds, there tends to be a lot of work involved in maintaining loan records. A manager would tend to outsource this to a loan administrator. If they're bigger, they may have a dedicated in-house team. However, it's really important to note that it can be quite time consuming and complex depending on how many loans there actually are. Also, with real estate portfolios, all asset income and expenditure, as well as development CapEx costs, these can be accurately recorded by a managing agent. Once again, apart from some of the much larger real estate managers, we tend to see this being outsourced to the managing agents. In particular, they oversee the service charges, which can once again be quite complex. And if when it comes to the quarterly reporting, that's something that's really important for getting the accounts out in time. I think that's it for my side. Back over to Shirley.
Thank you.
Or Lewis.
Yeah, I'll get started on this. Some of the highlights from the autumn budget, which took place last month on the 22nd of November. So with regards to national insurance contributions, Class 1 NIC's main rate was cut from 12% to 10%, applicable from the 6th of January 24. So what that means for employees in and above the upper NIC threshold, there would be a tax reduction of over £750 per year. With respect to Class 2 NICs, they are expected to be abolished, and the main rate for Class 4 NICs are to be cut from 9% to 8%. Both of these are applicable from the 6th of April 24. So what that means for self-employed individuals earning above the upper NIC threshold is a tax reduction of over £375 per year. No changes were announced to employer NICs, the NIC thresholds or rates for earnings above the upper threshold. From a business tax perspective, as part of the spring budget, one of the capital allowances introduced was full expensing, which lets the business deduct 100% of the cost of certain plant and machinery from their profits before tax. This is now being made permanent, so it's not subject to the time limit of the 31st of March 2026. And this being made permanent helps to reduce the impact of the earlier rise of corporation tax from 19 to 25%. And then finally, with regards to pensions, the government has announced that they will consult on giving pension savers a legal right to require new employers to pay pension contributions into existing pensions. The aim or hopes from this is that there will be a facilitation of a simpler pension market whereby individuals move towards having one single pension pot for life. The second hot topic from a tax perspective is the potential reforms to carried interest. The next general election is looming. One's expected by January 25. Members of the Labour Party have made announcements to try and seek in the region of £600 million of tax by taxing carried interest earned by private equity fund managers as income rather than capital. So what this means is that carried interest returns would potentially be subject to tax at up to 45% under UK income tax rates, rather than currently being treated as capital gains subject to tax at 28%. So far, the Conservatives have not made any announcements in relation to carried interest. So what this means, well, fund managers could now consider realising investments if commercially viable, or transferring entitlements of carried interest into holding companies such as a family investment company, or even considering their UK tax residency status. This is definitely an area to consider and monitor closely as the election gets nearer. Shirley, I'll pass to you for the third hot topic.
Thank you, Lewis. The third hot topic is the qualifying asset holding companies regime. This was introduced in the UK in April 2022, and it's a simplified holding company tax regime which aims to enhance the UK's competitiveness as an asset manager and investment funds location. So the QAC regime, as it's known, offers a wide range of tax benefits. So there's capital gains exemption, full exemption on capital gains on the sale of shares and assets, property, for example, except for shares in UK property rich companies. Gains and income on non-UK property are fully exempt. Share buybacks, gains on that are exempt from stamp duty and are preserved as capital for UK investors. A key one is that there aren't any withholding taxes on interest payments, which to claim withholding tax relief is very administratively burdensome. Dividend exemptions, as per normal UK rules, there's no withholding tax on dividends anyways. Interest in profit participating loans are tax deductible, subject to various other rules. So there's a huge range of tax benefits. It is important to be mindful that there are a number of eligibility conditions which need to be met in order for a company to be a QAC. Conscious of time, just going to summarise the key ones. The QAC must generally be owned at least 70% by category A investors, which include qualifying funds, certain qualifying investors, and other QACs. This is the most complex condition, and we have a lot of experience in helping to quantify the ownership condition and whether it's met. The QAC's main activity must be carrying on of an investment business. The QAC cannot acquire listed equity securities. A QAC must also be a UK resident company elected into the regime, not a UK real estate investment trust, and must not have equity securities listed or traded on a recognised stock exchange. And there are a number of reporting requirements. Another huge advantage of the QAC regime is that it's not subject to ATAD-free, which was recently introduced in the EU to prevent the use of shell entities for improper tax purposes. And note that EU jurisdictions may still consider substance requirements for non-EU holding companies seeking double tax treaty relief. However, for UK fund managers, the QAC regime really does offer a good alternative as an asset holding company location, operational ease in meeting substance requirements and avoiding unintended tax residency elsewhere. And I'll hand over to Langham Hall.
Thank you, Shirley. So now Heather and I are going to run through some management and admin considerations when setting up a fund structure. So below, on this slide, we're going to run through some of the key topics we can think of, but there are obviously a lot more. We'll run through everything relatively high level, but please do ask questions at the end if you do have any particular queries. So first of all, the domicile. This is a very key when setting up a fund. It's largely driven by efficiency of the domicile, target investor base, and the resource required to run the fund. I'll be focusing, there's also tax considerations, but I think the Alvarez and Marshall team have gone through that in quite a lot of detail. So particularly when European investors are concerned, managers should consider AIFMD and its influence on the route to market. Broadly speaking, there are two options for accessing European capital. One is an AIFMD compliant AIF, Alternative Investment Fund, under the marketing passport, or registering a non-European AIF on a country-by-country basis through the NPPR, which stands for the National Private Placement Regime. I'll just very quickly go over some of the key differences between an AIFMD passport and NPPR. So AIFMD passports, they tend to be Luxembourg structures. That's the most popular. LPs seem to recognise Luxembourg structures a lot more. For example, German insurance companies actually have larger capital allocations for AIFMD compliant funds in Luxembourg. Sorry, there's a light in this room that keeps turning off. So the benefits of going down that route is it's much wider recognised. You can access most European countries through the AIFMD passport. However, it is an expensive structure to set up. So unless you're raising 150 million plus, the ongoing operational fees, for example, full scope AIFM, depository, administrator, and legal fees, they're going to be a really big drag on the IRR of a fund. The NPPR route does actually have a wider range of fund domiciles available. The UK and Channel Islands are really popular with the NPPR. Not every country though does have a workable NPPR. So Italy, France and Spain are very difficult to access. So it's all dependent on the LP base. But very high level, the UK and Channel Islands are much cheaper to operate from a fund perspective. So the most important takeaways are to go by your LP base, check the tax and the ease of operation. And then over to Helen.
Thanks, Nancy. So those of you who have attempted to navigate cross-jurisdictional marketing before, and as Nancy has described, you know all too well the headache that it can bring. ESMA is increasingly suspicious of fund sponsors who are relying on reverse solicitation, having released a clear edict in 2021 disparaging firms attempting to circumvent Brexit by using what they call tick box reverse solicitation approaches. Some even argue that using reverse solicitation is essentially giving an investor a put option, which allows the investor to recoup their money if things do go wrong in the fund journey by alleging marketing to them was illegitimate. For firms wishing to market into the EU or UK, there are product and personnel considerations to take into account. For the former, depending on the domicile of the vehicle, it may be that you need product registration, as Nancy has covered, so your NPPR or your AIFMD passport. Pre-marketing, i.e. the marketing of a potential product using draft documents, can be very helpful in assisting fund sponsors choose a route forward. Although there have been some key changes to the pre-marketing regime in the EU, which I'll cover a little bit later on. On the topic of personnel, the persons conducting the marketing of the product may also require regulatory cover. In the UK, for example, disseminating financial promotions is subject to rules under the financial legislature, as is arranging for an investor via subdoc to come into the vehicle. Similarly, in the EU, IR professionals would expect to be regulated with MiFID permissions. Some fund sponsors, however, prefer to capitalise on the networks of regulated placement agents, be that in the EU or the UK, or further afield. However, in this current economic climate, there are many placement agents being far more discerning on the mandates they choose to take on. This leads me into regulation, which is often one of the last things that lots of people like to think about, but it really should be one of the first considerations in a fund journey. In the UK, the Financial Services and Markets Act makes a number of activities regulated and therefore requiring some form of regulatory cover or authorization. As mentioned, this might include financial promotions or arranging subdocs, but crucially also might include advising on designated investments. Most commonly for fund sponsors we work with, that will be shares. For first-time fund sponsors, cost efficiency and speed are important. The appointed representative regime allows firms to have their regulated activity covered by a regulated firm. It takes around 3 months to get set up in this manner, and there are no regulatory capital requirements or fees payable to the regulator, so many spin-outs and startups prefer this route. However, the appointed rep regime does not allow firms to make investment decisions, and the regime has been subject to some scrutiny by the regulator of late. Alternatively, some firms prefer the freedom afforded by direct authorization, which enables firms to apply for the broader range of potential permissions. However, this does come with regulatory capital considerations, and the time it takes is longer, ranging between 6 to 12 months, not including preparatory work. And with that, I'll let Nancy pick up on the administration point.
Thanks, Helen. So once the fund is set up, the ongoing accounting and admin is very important for making sure the actual the fund operationally runs smoothly. There are so many different points to consider when it comes to the reporting, but the main two considerations I'll go through are the reporting standards and currency. So first of all, the jurisdiction of the fund will drive the accounting standard decision. Most European structures report under IFRS, which was adopted by the European Union. However, there are some instances where individual entities will report under the local GAAP, so that this will change some of the reporting requirements for those entities. For example, US entities report under US GAAP, which is a much more rule-based approach as opposed to IFRS, which is a principle-based approach. There are cases where there are multi-jurisdictional fund structures where certain entities are under US or Luxembourg GAAP, whereas the consolidated fund is actually under IFRS. It's really important for making sure that you're aware of the differences between these accounting reporting standards. It can be a bit more time consuming for your in-house and external accounting team. Another important element to consider is the multi-currency structures. For example, a real estate fund may have a number of asset holding entities across Europe and the UK. Some entities may be reporting in sterling, some entities may be reporting in euros, but then at the consolidated level, everything's in sterling. So the risk that you've got there are the FX risks and translation risks. There are going to be FX differences throughout the year. You need to make sure that you're using the right spot rates. Also, FX translation, we've seen in a number of cases where transactions haven't been translated correctly. It gets to the end of the year when the audit is going on, and there's a huge reconciliation between different currencies. So it's definitely something to consider. I guess with all accounting and admin points, it's really important that you get the right structuring and advice from the very start, and you really rely on your outsourced admin and accounting team to know exactly what needs to be done. And then final point will be investors. Back over to Helen.
Thanks, Nancy. So we've touched on investors from a number of fronts, but what's also important to consider is the classification of the clients that you're seeking to invest with you. In the UK, 3 categories of investors are of particular relevance. Retail clients are in practice ordinary people like you and I, and some other classes of investors such as local authorities, their pension schemes, and many small businesses. These investors naturally are afforded the highest level of protection in their financial endeavours, including products that they can be marketed. And in fact, there is a restriction on most illiquid fund structures to be marketed to retail clients. Per se, professional clients, alternatively, are those who are large undertakings and institutions which do not need the same level of protection as retail clients due to the fact that their primary activity is investing. They have a fluency in financial markets and risk management, as well as cash flow to support themselves. That might include insurers, pension funds, banks, or sovereign wealth funds. Crucially, elective professionals are those who would otherwise be considered as retail if they hadn't been assessed in line with certain thresholds, which we call the opt-up process. Crucially, for many startups and spin-outs, high net worths are a key target. They may be considered retail and are explicitly included in groups requiring further disclaimers in recent reforms to financial promotion rules. So fund sponsors wishing to pursue high net worths should do so compliantly and not assume that they can always be treated as professional without any due process with respect of those individuals. For those firms dealing with retail clients, even indirectly, it is important to consider consumer duty, as it's likely the product journey will be impacted by those requirements which obligate firms to deliver good outcomes for retail customers. And I'll hand back over to Nancy.
Okay, so we're actually on to the final slide. We've selected some of the hot topics that we're seeing with our clients and in the industry, but I'm sure there are lots of other ones. So first of all, ESG is obviously a very hot topic at the moment. I don't think you could go to any conference without this being at least one of the panels. We've seen that there's a big rise in importance of ESG in funds, even those that aren't impact focused. In particular, we're seeing a lot of funds hiring in-house ESG teams, and there are roles such as head of ESG that wouldn't have even existed, I don't know, even 5 years ago. So most funds will report following the SFDR, which stands for the Sustainable Finance Disclosure Regulation. This was introduced by the European Commission in 2021. I won't go into too much detail, but a couple of key points to know are that the SFDR we found actually does have a number of drawbacks for European fund managers. The main one being that the classifications, especially for Article 9 funds, are quite rigid, which has resulted in many managers actually stepping down from an Article 9 status due to the intense reporting requirements, hence why many managers are hiring in-house ESG teams. There's also the topic of greenwashing that I've seen in lots of articles and conferences recently. This has enabled some managers to tick certain boxes and be able to market themselves as an Article 8 or 9 fund. This obviously has helped with European LP allocations, when in fact maybe they aren't actually marketing their fund as impact focused to the rest of the world. There are some US managers, for example, who don't care as much about ESG, and we've heard of cases where managers have literally just changed some of their marketing material to cater to different types of LPs. There's the new UK SDR, which is aiming to combat some of these issues. It's not actually in place yet. The consultation period closes early 2024. I believe it should be in place by the end of 2024, but I need to double check that. It keeps changing. But the main differences with the UK SDR as opposed to the European SFDR is that they are changing the sustainable investment labels, which will alleviate a lot of the greenwashing issues and provide greater transparency. It also means that it won't be so rigid for Article 9 managers who maybe have invested in an asset which is carbon intensive at the time, but then they want to invest in making that more of a sustainable asset. I could probably go on for hours on ESG, but I'll move on to the next point for the sake of time. Debt financing. We obviously, in recent year, the cost of debt has gone up significantly, and this has had a really big impact on a lot of our managers. As a result, we're seeing the slowdown of deals across the board. A lot of managers have mentioned that the level of due diligence and decision making involved in each deal has doubled. So each manager is spending a lot more time on deals. There are less deals in general happening each year. We've also seen, in particular in real estate, some distressed sales of assets where LPs maybe want to take their money out of the fund, and the manager doesn't have enough liquidity in the fund. This has obviously meant that the return on investment hasn't been as high as desired. But then also on the flip side, some managers have been able to pick up some cheap assets. Democratization of funds. This is something that I'm also seeing a lot of in seminars and at conferences at the moment. In essence, democratization means opening up alternative investment funds to smaller and individual investors who previously didn't have the ability or opportunity to invest in private markets. Alternative investment funds, they're usually a lot less liquid than publicly traded assets. However, thanks to technology, and there are lots of firms out there, as well as the change in regulations, for example, the LTAF and LTIF, which I'll go into in a few seconds, this has meant that investing in these funds can be a lot more simple and offer flexibility. So very high level, the LTAF structure, that applies to the UK, was set up in 2021, and it can admit UK professional investors and high net worths. The LTIF, which applies to all EU states, that was set up in 2015, and it's a type of AIF which is closed-ended and open once again to institutional and retail investors. There's definitely been a rise in these types of funds over the last year. And then final 3 points, Helen.
Thank you. So touching first on cross-border distribution, in August 2021, the EU harmonised the definition of pre-marketing across the EU. I won't go into too much detail on what that means in practice, but what it has precipitated is the concept of pre-marketing, and please excuse me for the less than creative name. This is the concept of non-product related marketing, such as brand awareness and track record, which becomes particularly relevant for budding fund sponsors during conference season and fund roadshows. Fund sponsors should be cautious, as indiscriminately pre-marketing might complicate later claims to reverse solicitation, and given the regulatory focus on marketing, it's important that fund sponsors have the right support and the right cover in place. Not to scare you too much, but a key recent case found a French placement agent fined €200,000 and disallowed from distributing for 5 years for actively marketing funds without approval and then claiming that all investors were made via reverse solicitation. On EU divergence, there's actually been very little EU divergence as of yet, and the appetite for excessive change is low. There are signs of divergence, however, including the implementation of SDR in the UK, which Nancy has touched on. Additionally, the next iteration of EU IFMD, known as AFMD2, is likely to come into effect in 2026. And again, please excuse the less than creative naming from the EU. The reforms focus on delegation, loan origination, and conflicts of interest with third-party AIFMs, amongst others. But the FCA has not indicated it will follow the same path as the EU with respect to AFMD reforms, but has confirmed a consultation process on asset management rules with the aim of taking a smarter approach to proportionality for UK AIFMs. This creates a risk of divergence from the EU, which will have to be carefully navigated by AIFMs with cross-border elements to contend with. Finally, I'll touch very briefly on Ireland as a fund domicile. It is certainly up and coming, and it is the third largest global centre for investment funds. What we've seen generally, it's as popular with hedge funds and liquid credit funds, as well as fledgling crypto funds preferring to be domiciled out of Ireland. For US managers, for some, it holds historical importance for them, and the fact that it's an English-speaking domicile is a key benefit. That said, Luxembourg funds hold €5,064.8 billion in assets under management, and it remains one of the most popular domiciles for all alternative investment funds. The Irish regulator does not have such an established reputation for its approach, and we have heard that they are less organised for matters such as registration compared to the CSSF, the Luxembourg regulator, which is a veteran in the AIF world and well known for being a strict regulator, especially in relation to KYC and AML. Nevertheless, we expect that various jurisdictions will develop their specialisms and build their fund offerings to meet those. And with that, I'll hand over back to the Alvarez and Marsal team for closing remarks. Thank you, everybody.
Great, thank you so much. Just want to check if anyone has any questions first. No? Oh, Charles has a question. So I see Charles' hand is up. Possible to...
Yes, hello. Can you hear me?
Hello, yes, could hear you now.
I'll just thank you very much for that presentation. It was really fantastic, and I've been taking notes. But just in terms of the these direct funds, is there any sort of advantage or disadvantage between customer expectations at the moment with regard to distributions? I was sort of looking at the private equity and private capital and also at the strategies that were being discussed about long-term capital appreciation, strong income. Just from two perspectives, in terms of the investor expectations, whether you see any demand for different types of funds along those lines, and also from a tax perspective, are there any advantages for sort of longer term sort of rolling up distributions or distributions along the way?
Perhaps I can jump in and answer that one insofar as one of these things will ultimately depend on investor expectations. So what's been sort of promoted to them via, say, the PPM. I think in terms of from a pure tax point of view, generally we would prefer capital over income, but that's got to be balanced against, say, the overall IRR of the fund. So if there is cash to distribute, or generally, unless there's a really valuable usage for that cash, that will tend to be distributed as soon as possible. I think the only other sort of variable to add to that equation is the use of debt to sort of change that perspective. So if there is a sort of a leverage strategy going into sort of the asset, it may be preferable to use some of the income generated from the fund to repay debt, to sort of limit distributions from the fund. So not an easy question, Charles, but I would say it's really a balancing between those three factors.
No, it's a very difficult question, but I think you answered it very well, and thank you. That's a good point about structuring debt. Do you advise then with the using debt within them, and what sort of mechanisms are there for debt onshore and offshore to come into the? Do people tend to have funds that have other funds that are investing debt, or is the debt coming in from a commercial banking or issuing a bond? But what's a typical sort of structure that do you see?
So I suppose most funds will often use a subscription line at the level of the fund to finance LP commitments, but there's a variety of ways debt can be structured. I think we could do a whole presentation on that, and I imagine there's a lot of regulatory issues as well that the Langham Hall team would want to cover off. But broadly, I suppose the two most common forms, excluding the subscription line, would be asset by asset financing, where debt's bought into the level of, say, an SPV to finance an asset, and NAV financing, which I suppose is a bit of a hot topic at the moment, whereby fund level debt is bought on secured against the entire value of the portfolio. I think that the typical form would be to arrange that with a bank and use something like a revolving credit facility. But again, a pretty complex area that requires careful structuring and of course a lot of tax implications there.
Brilliant. Thank you very much. I look forward to following up with you.
Thanks, Charles. Cheers.
Anyone else? If not, then no worries. We will send around our contact details. If you have any follow-up questions, feel free to ask any one of us. And thank you so much for your time in attending this presentation. Thank you.
Thank you, everyone.
Thanks, everyone.
Thanks, everyone. Bye-bye.
Good day. Bye.